year when I write that letter, I try to think of what are the most important things. And I would add to that the free Western world, because that's what worries me the most is that the Ukraine war, the terrorist activities in Israel.
Jamie Dimon's latest insights have sparked intense discussions about the US and global economies. Inflation, rising debt, and geopolitical tensions are creating economic uncertainties. But with so many variables at play, how prepared are we for what's coming next? The recent statements from JP Morgan Chase's CEO Jamie Dimon have turned heads, sparking conversations that stretch far beyond Wall Street's usual financial chatter. He touched on various pressing issues, from inflation to fiscal deficits, and even global geopolitical tension. So, what's got everyone talking? To begin, Dimon's outlook on a so-called soft landing for the US economy is far from optimistic. A soft landing occurs when the Federal Reserve, through gradual adjustments in monetary policy, think about interest rate hikes, manages to cool off a heated economy just enough to keep inflation in check without triggering a recession. Dimon has placed the odds of pulling this off at just 35 to 40%. Why such a low chance? He believes several persistent forces, even if less noticeable in the short term, may restoke inflation over time. Then, there is the aging population, which isn't just about increased healthcare needs. As more people retire, there's pressure on the labor market, possibly driving up wages and, naturally, the prices of goods and services. Interestingly, Dimon noted that the current US inflation rate has come down from last year's peak to approximately 2.4%. Good news, one might think. But according to Dimon, this figure is just a snapshot, one that doesn't factor in the underlying pressures that could easily push inflation back up. In other words, while inflation may appear contained for now, it's a fragile calm that could be disrupted by these deep-seated issues. And that's just on the domestic front. Dimon also highlighted the role of geopolitical conflicts, pointing to ongoing situations in Ukraine and the Middle East. These conflicts don't just make headlines, they also impact global supply chains, and subsequently, prices for essential goods. But it goes deeper than individual conflicts. Dimon observed that countries like Russia, Iran, and North Korea are forging alliances, often with quite backing from China. The emergence of this coalition is unsettling for a world order largely maintained by the US and its allies since World War II. So, what's the concern? This shifting geopolitical environment might force the US to adjust its defense strategy, likely leading to increased military spending, a move that again could keep inflation bubbling. Let's take a moment to examine the last point on military spending. In 2023, global military spending reached $2.4 trillion, with the US contributing a hefty share, $916 billion, marking a slight increase over the previous year. This spending isn't solely about defense. It's also about securing economic stability. After all, global trade relies on safe routes, and disruptions in strategic regions, such as those caused by the Russia-Ukraine war, can lead to significant delays in supply chains. Dimon warned against any illusion of peace, urging that the US recognize the need for readiness in a world that may be less stable than it once seemed. Dimon also raised concerns about America's fiscal health, particularly the growing federal deficit. In simple terms, the government is spending more than it's bringing in, a gap often closed through borrowing. This approach, however, has its consequences, especially in an environment of high interest rates. When rates are low, borrowing is relatively cheap. But recent rate hikes by the Federal Reserve have made this strategy much more costly. The higher interest payments required to service the debt now add substantial pressure to government finances, and Dimon emphasized that the challenge isn't just today's interest payments, but the compounding effect of refinancing at these elevated rates. Dimon pointed out that America's debt now hovers around 120% of its GDP, a level many economists, himself included, view as unsustainable. For comparison, back in the 1980s, when the Fed aggressively tackled inflation, the debt-to-GDP ratio was just 35%. Quite a difference, right? And the annual deficit back then was around 3.5% of GDP. Fast forward to today, and the situation is far more complex. Dimon suggested that such a high debt level might prevent the US from employing similar monetary tactics without risking severe economic fallout. To address this, he proposed forming a bipartisan commission similar to the 2010 Simpson-Bowles effort. His concern is clear. If the country continues on its current path, it might face a fiscal crisis, possibly even leading to austerity measures, a prospect with potentially destabilizing effects on both domestic and international markets. There is also Dimon's take on interest rates. He warned of a higher for longer interest rate environment. For over 20 years, low interest rates fueled significant economic growth, allowing both businesses and the government to borrow affordably and invest. These low rates also propped up the stock market as investors preferred stocks over low-yield bonds for better returns. Now, with the Federal Reserve hinting at a shift away from this low-rate model, Dimon pointed out that this could fundamentally alter the dynamics of borrowing, investing, and spending. Dimon's caution toward the US stock market isn't exactly a bold prediction, but rather a warning grounded in recent trends. Despite the S&P 500 remaining near record highs, Dimon questioned the sustainability of these valuations, especially given the limited IPO activity. In his view, a strong IPO market reflects robust investor confidence and economic optimism, as companies seek to raise capital at favorable valuations. Yet, despite high levels in public markets, there has been a noticeable decline in IPOs. According to Dimon, this hesitation stems from both cautious private companies and investors wary of inflated prices. Companies have increasingly turned to private markets to secure funding, suggesting a cautious stance toward public valuations. JP Morgan's role in the IPO market gives Dimon an inside perspective on these trends. While he acknowledged that some companies may be waiting for better market conditions to go public, he also hinted that current valuations might be overly optimistic. This suggests that the stock market's apparent buoyancy could be masking vulnerabilities, particularly if inflation, fiscal issues, and global risks play out as he anticipates. Dimon's warnings extend to the debt landscape in the US under normal circumstances. High levels of debt might not be immediately alarming, but as Dimon pointed out, these aren't normal times. With debt levels at an all-time high and interest rates on the rise, the cost of maintaining this debt has become a major concern. In an era where refinancing at higher rates could compound the debt problem, Dimon urged for greater fiscal responsibility. He even went as far as suggesting the need for a bipartisan approach, noting that tackling such deep-rooted issues may require cooperation beyond the usual party lines. His reference to a commission like Simpson-Bowles underscores the urgency he feels in addressing America's fiscal challenges before they spiral further. Dimon's analysis suggests an economy on shaky ground, with high inflation, growing debt, and global risks pressing down. Are we entering a new era of economic challenges, or is there a chance for stability? Share your thoughts in the comments below. Don't forget to like, share, and subscribe.